Alright, so Tesla announced a stock split and the stock popped 8% on the news. This move added over $90 billion to the market cap. Or, put differently, 1.3 General Motors. Wait, what? For anyone with a traditional stock market education, easily identifiable by the uniform, this is of course absurd. Stock splits don't create value, they merely toggle the share count, while ownership percentages and corporate fundamentals remain unchanged. Or, at least that used to be the thinking. In this video, we're going to run through why, as crazy as it sounds, Tesla's stock split is actually incrementally positive for the shares. Hint, it has to do with the options market. Alright, so let's get into it. To start, I want to briefly run through the traditional view of stock splits and why companies chose to keep their prices either artificially high or low. On April 9th, 2001, the US Securities and Exchange Commission, the SEC, ushered in the modern era of stock decimalization. Prior to this, stocks could only be traded in increments of 1/16th of a dollar, or roughly 6.25 cents, compared to post-decimalization, where stock prices can now move by as little as a penny. Why does that matter? Well, execution cost is the big thing. Imagine you wanted to buy a penny stock with a price of $1. If you had to buy it at the next tick, that would mean exchanging $1 and 1/16th, or $1.06, which means you're eating 6% of the cost just to get into the market. Additionally, even post-decimalization, brokers typically charged a flat fee on a share-by-share basis. So, a lower stock price meant buying more shares, and thus paying more in commissions. For this reason, lots of companies chose to keep their stock prices high and not splitting them to spare the investors the burden of higher transaction costs. The classic example of this is Warren Buffett's Berkshire Hathaway, where the A shares currently trade at over 500,000. Woo! The counter to this is that historically individuals had to cough up the exact amount in order to own a share. If the stock you wanted cost $600 and you only had $550, well, too bad, keep saving. For this reason, lots of companies with large retail investor bases tended to split their stock to keep it accessible to the everyman. Today though, this isn't a problem due to fractional share ownership options offered by nearly all the brokerages. Now, if you want a slice of those delicious Berkshire A shares, but only had $10,000 to invest, you don't have to wait until you get another $520,000. You can go out and buy your 0.019 shares today. Hooray! Anyway, the moral of the story is that today, it doesn't really matter what your stock price is, because with flat fees, payment for order flow, and fractional share ownership, retail investors aren't in any way impinged upon by the relative size of a stock's price. Well, that's partially true. Stock price, yes. Stock options, no. While the world of equity investing has approached something of a retail renaissance, the options world is still in the dark ages. A weird Reddit hype-fueled dark age. Lots for options still come only in 100 share packages. So, with Tesla's stock price currently at $1,000, if the medium-dated, out-of-the-money call options you've been fetishizing cost $50, then you'd need to cough up $5,000 just to buy the minimum. However, if Tesla does a 5-for-1 stock split, this becomes $1,000, which is much more accessible. The net result here is that with the stock split, investors can almost guarantee that options activity on Tesla's stock will pick up, and likely materially so. And quickly, if you're enjoying this video, please hit the like and subscribe buttons below for more entertaining takes on the business world and financial markets. I'm just starting out, so it really helps to get some momentum for the channel. Okay, back at it. Now, obviously a call option isn't the same thing as owning a share. It could expire worthlessly out of the money and leave no trace on the NASDAQ or NYSE to which it expired. But the bank who sold you that option, however, will likely have to engage in some measure of stock dealing as a result of your purchase. Banks dynamically hedge themselves when they sell call options to investors by buying a fraction of the underlying shares. The dynamic part relates to how much they buy. Without going crazy and getting into options pricing with Black-Scholes, options have a feature called delta that relates to its price change in relation to the underlying stock. In the case of a call option, if it's really out of the money, the delta will be close to 0. If it's really in the money, it'll be close to 1. Banks hedge the call options they've sold by holding a fraction of shares roughly equivalent to this delta. If the stock price increases, the value of the option will increase along with its delta, and the bank needs to go out and purchase more shares in order to remain fully hedged. In extreme cases, like ones we've seen recently with retail favorites being punted around heavily in the options market, excessive option buying can lead to something of a self-fulfilling prophecy. More options means banks will have to go out and buy more of the underlying stock, which increases the price, which increases the delta, which means they have to buy yet more stock. In extreme situations, this can lead to something called a gamma squeeze. Now, I'm not proposing that this will happen to Tesla, but undoubtedly options activity will increase, and as it does, it will provide incremental pressure upwards on the shares as banks manage their delta hedging. For just a regular, boring company, this would probably go unnoticed, but for Tesla, a retail golden idol with its white knight meme god founder, this news will simply not slip through the cracks. Alright, so that's my quick take on the Tesla stock split. I hope you found it interesting, and if you did, please give it a like or consider subscribing for more informative and hopefully entertaining financial content. And if you have any suggestions for what company or topic I should take a crack at next, please let me know in the comments below. I'm Ryan, and thanks for tuning into Market Lab.